Welcome to SmallCap Asia, a platform dedicated to help you identify promising opportunities in the Asian financial markets. I'm Xinying, your host, and this interview is disseminated on behalf of Global One Media. Joining me today is Moneer Barazi, Head Analyst of Global One Media. Hi, Moneer. Thank you for joining us today.
Hi, Xinying.
So
Thank you.
Today we'll be discussing the current market turbulence, the breakdown of traditional investment strategies, and what this means for investors across Asia. We will also explore how portfolios can be positioned amid rising volatility and structural shifts in the global economy. So let's kick off with the first question. Right now, we are 5 weeks into a war that the IEA has called the greatest energy security challenge in history. Asian investors are watching a Kospi down 16%, Nikkei down 10%, and LNG prices up 77% in just less than 2 weeks. So for a retail investor in Asia sitting on a portfolio right now, what is actually happening? And why is this crisis hitting Asia harder than anywhere else in the world?
Well, the thing about crisis, Xinying, is that they don't impact everyone equally. And that applies to most crises in history. People and countries and economies have different levels of exposure to different exogenous shocks like this one. And one of the reasons why this has been particularly impactful in Asia is because of the high dependency. Most Asian economies depend on imported energy. And if you look at the statistics, they reveal a very clear picture. In 2024, 84% of all crude oil and condensate through the Strait of Hormuz was destined for Asian markets. Japan imports 94.2% of its total oil through that strait, and many other economies have also slightly lower, but similar levels of exposure to shocks and import restrictions of this kind. And also, the scale of this crisis has been different. Today, or previously, before the most recent truce between the United States and Iran, 12 million barrels per day were blocked, whereas in previous crises in 1973 and others, we were talking about blockage of 5 million barrels of oil. And so this dependency is mainly the reason why the impact has been severe on Asian economies. Of course, if you look also at China, China has slightly lower exposure because it has elaborate networks through which it can import oil from Iran. And there's been talks also about allowing yuan denominated oil to pass through the Strait of Hormuz, and that might challenge the dominance of the petrodollar, but that's a conversation for another day.
And that brings us to something that has been puzzling a lot of investors. One of the most striking things that we have seen is that the traditional safe haven playbook has broken down. Stocks fell, bonds fell, and even gold fell. Some investors ran to cash only to watch inflation eat into it. So for Asian investors who have been told their whole lives to diversify, what does diversification actually mean in an environment where everything is falling together?
Well, again, we go back to what happens during crises, and we often see that during a crisis, many asset classes go down in parallel. So the correlation between them increases. And that actually provides less protection for investors. Investors used to use the 60-40% rule, where they allocate 60% of their portfolios to equities and 40% to bonds or fixed income. But that doesn't really provide protection anymore. And that's a lesson that many investors have learned from the past. So the question is now, how do we really build real diversification into investors' portfolios? And to answer that question, we need to know what we're diversifying for. And that would be, we need to have portfolios that have different levels of exposure to inflationary shocks, because this war has caused inflationary shocks because of what happened in the energy markets. And when you have different portfolios that have different asset classes that have different levels of exposure to inflationary shocks, then you can get some level of protection. And the problem is for many investors is that we're dealing now with stagflation, which means growth has been decoupled from inflation. So we have limited growth and high inflation at the same time, and that is challenging for central banks to deal with. Now, to answer your question about what investors need to invest in to protect themselves, well, one of the good plays I would think is defensive stocks. There are still good stocks like healthcare and utilities and similar kind of equities. Some energy equities can also provide good protection now that since they have positive exposure now, they can rise with higher energy prices, and also commodities. That's very important. Commodities offer a very balanced exposure and they provide good protection against those kinds of shocks. And we've seen that they don't have a high correlation, or they don't have equal correlation with both equities and fixed income. So they are a good asset class to look at.
So let's zoom out for a moment because there's a bigger structural story here. Zooming out from the war itself, the West is in a full-scale race to secure critical minerals. Europe has just legislated a permanent ban on Russian gas, and China has been weaponizing rare earth export controls. These are decade-long structural shifts that were already in motion before a single shot was fired. So how should Asian investors be thinking about the bigger picture? And what sectors or geographies does it actually point them towards?
It's a very good question. And the three themes that you've just described, the critical minerals, the independence of Europe when it comes to Russian gas or trying to head that way, and also when you talk about rare earth as well, where China has a lot of control in both mining and processing, they really all are symptoms of one root cause, which is the politicization of supply chains. Previously, supply chains were about efficiency, were about which country can supply goods at the better costs, and so on. But now we're seeing decoupling from efficiency, and we're seeing politicization of those supply chains. So now the West wants to regain independence or regain control over the supply of critical minerals. And that's why you see projects like Project Vault in the US, where you see the American government has invested directly into some commodity suppliers or explorers. You see also Europe now. Europe has switched to relying on terminals when it comes to liquefied natural gas instead of relying on pipelines. And those terminals will allow Europe to receive gas from different suppliers rather than just relying on Russia. And that actually might entail that there might be some competition between Asia and Europe when it comes to securing that needed gas. If you want to understand the bigger themes or security, then I think now Asia, particularly Australia, when it comes to Asian investors, Australia is a very good place now to diversify and establish exposure to the critical minerals race now, and also in the energy dependence. If investors can find good suppliers of liquefied natural gas in Australia, that's also a good option to have.
Okay, so let's bring it back to the practical. What do investors actually do right now? Because recently we have seen markets being sold off and volatility elevated and the news changing by the hour. So what are the concrete opportunities right now? And what is actually being mispriced? What sectors or assets have been punished? And where should an investor be deploying capital versus staying patient?
That's also a good question because, again, this is an exogenous shock. And history has taught us that those kinds of shocks, markets tend to price the worst case scenario very quickly. And so that means that recovery can also happen fast afterwards, after investors have realized, okay, maybe the worst case scenario is not materializing. So that also needs to be taken into account. So we're seeing many Asian equities are recovering, which is a very welcome sign. We're seeing even technology stocks also recovering to some extent. I'm seeing V-shaped reversal on many charts. Even when I'm looking at the crude oil chart, I was looking earlier today and I noticed many, technically speaking, I noticed many wicks on the 10-day time frame, and that could mean perhaps a pullback. So we might see some reprieve when it comes to energy prices. or at least oil prices, that's a relief for the global economy entirely. One opportunity is any type of service or manufacturing that is not as energy intensive, like the industries that rely a lot on energy. I mean, investors would be wise to avoid, at least for now, the energy intensive industries like petrochemicals and others. But they can also establish good exposure by, as I said earlier, looking at Australia. It provides lots of good opportunities. It's close to Asia. The mining industry in Australia has been maturing, and investing in processing capacity, mining also is a good play, including exploration companies. Exploration companies can offer good exposure at a lower price, so that could offer good leverage for investors. Another option would be defensive technologies and defense minerals or commodities like tungsten and niobium, scandium, and others. They are all in demand right now. And also energy companies at large. They are also good plays now because there will be a recovery at some point, but for now, we will still witness the ramifications of that war because the ships that were passing the Strait of Hormuz have just now arrived. And the pain might now begin to be felt right now. But generally, defensive stocks, less energy intensive stocks, energy companies, commodities are all good plays here.
All right, Moneer, that's all the time we have. Thank you for sharing your insights with us today. And to our viewers, thank you for watching SmallCap Asia.